Mark Twain is known for saying, "History doesn't repeat itself, but it often rhymes." And when it comes to stocks, you may say, "I don't know, so let's go." Before digging into the weekly, let's look at the daily on SPY. Okay, let's talk about the big elephant in the room. On Thursday, we saw a strong intraday reversal. So let's ask ourselves, have we seen something similar in the past? And the answer is yes. If we look at the end of July, the same thing happened on a Thursday, right before July's CPI print. And from top to close, we had almost a 1.5% reversal. Now that was of course followed by a dead cat bounce going into the CPI print where it struggled to break the golden pocket. Now if we fast forward and look at the price action from Friday, it looks like we're doing the same. And when the CPI print came out that Wednesday pre-market, the market sold off and was the start of a 10% correction. Let's see on Monday and Tuesday if we struggle to break this golden pocket area, and if we once again start a corrective move on a hotter than expected CPI read. One thing for sure is with SPY forming a triple top, the bears clearly know where their stop loss is at. And if we zoom in here, if we see the 5 exponential moving average on the daily cross below the 20 simple moving average, then this signals a trend change. When we pull up a heat map of the S&P stocks and how they did in the past week, we notice that energy is doing well. And typically when energy is doing well, nothing else is. And if semiconductors are ready to start cooling off, as they have been the source of our latest rally, maybe SPY and the Qs are ready to do so as well. If we flip over to the percentage of stocks trading above their 50-day simple moving average, it looks like we're seeing a reversal. If this sees follow through this week, then likely we're starting a correction. Now, I'm not going to be like other YouTube channels and try to scare you with words like we're going to crash, as GDP growth has been strong. And have you ever heard of a market crash when companies are doing well? Didn't think so. And if we flip over to SPY on the weekly, we notice that even though we had slightly higher than average selling volume, this week we did manage to hold the 5 EMA. Now the MACD momentum seems to be waning, but we haven't seen the MACD line cross below the signal yet. So let's call this one 50-50. Maybe the Qs will give us more clarity. Now the Qs don't look quite as strong as they've been moving sideways for 6 weeks. Has this been some form of distribution? And on this chart, on the weekly, the Qs were not able to close above their 5 EMA. They lost it on higher than average selling volume, and they got a cross of the MACD line below the signal. On the weekly, this one takes time, and it starts to feel like the Qs are maybe signaling they are ready for a correction. Flipping over to the IWM, yeah, the Russell, this was definitely an underperformer. And if we look at this 2-week candle pattern here, we see that it was bearish engulfing. Now, until we retest this 200 area and lose it, I'm not exactly feeling bearish quite yet. But as we enter into earnings season at the end of next week, with banks kicking them off as financials make up a decent chunk of the Russell, this will definitely play a role in price action. So as long as we can hold this 200 area, I'm a likely buyer of TNA to play the bounce higher. And anytime we get near support, I like to do this because I know that my stop loss is close by. And if we flip back on the Bollinger Bands, we see the 20 simple moving average, and maybe this would be the likely area of support as well. The US 10Y yields this week, they had a chance to just go ahead and melt away, but instead they bounced higher. And no doubt this week's CPI will have a definite impact on these as well. And when we look at the VIX this week, we see that we saw a surge in volatility up almost 25%. Now, with that said, we're just barely above 16, which I wouldn't call a worrisome area. But if we look at this purple line, which is the 200-day simple moving average, getting above this area can be worrisome. Where I'll really start to get on guard is if we start to get above the 18 to 20 area. Like I mentioned earlier, CPI and PPI are on the economic calendar next week, as well as the release of those pesky Fed meeting minutes on Wednesday as well, with a bunch of Fed chatter scheduled as well mid to later in the week after the CPI print. Could all of this cool what has been a hot start to this year? As that's all I have for now until the next video, and we'll see you then.